What if the biggest lie about cryptocurrency isn't that it's a scam, but that it's new? Every boom in digital assets is marketed as a clean break from history. A revolution so powerful, it finally frees money from governments, banks, and human error. But here is the mystery. Why do crypto crashes look eerily similar to financial disasters from centuries ago? Why do the same emotions, the same promises, and the same collapses keep repeating, even when the technology changes? Tonight, we're not asking whether cryptocurrency will survive. We're asking something more uncomfortable. Has this story already been told and ignored again and again? To understand where crypto is going, we must trace where it really came from. And the truth leads us far away from Silicon Valley and deep into the oldest mistakes humans make with money. Setting the stage, history, key figures, and hidden forces before Bitcoin, before Ethereum, before the word blockchain ever entered public conversation. The world was already drowning in financial distrust. The year was 2008. Banks collapsed. Governments rushed to bail out institutions deemed too big to fail. Ordinary people watched their savings vanish while executives walked away richer. Trust in centralized finance shattered, and into that vacuum stepped an idea. Not a company, not a bank, not even a country. A 9-page white paper, published by a mysterious figure calling themselves Satoshi Nakamoto, proposed something radical: money without trust. A system where math replaced banks, code replaced institutions, and verification replaced belief. Bitcoin wasn't designed to make people rich. It was designed to remove power. But here's the twist. History shows us that whenever money removes one kind of power, it almost always creates another. And those who recognize that first usually win. Origins: why cryptocurrency was born. Bitcoin emerged as a response to crisis, not innovation for innovation's sake. At its core, Bitcoin solved a problem economists had wrestled with for decades: the double spending problem. How do you prevent digital money from being copied infinitely, like a file? The blockchain answered this by creating a public immutable ledger. Every transaction was recorded. No single authority controlled it. Consensus replaced command. But while the technology was revolutionary, the psychology behind it was ancient. Scarcity, trustlessness, fear of debasement. Bitcoin's fixed supply of 21 million coins mirrored gold's appeal. It promised protection against inflation, corruption, and political manipulation. And at first, almost no one noticed. Bitcoin traded for pennies. Early adopters weren't investors. They were ideologues, programmers, libertarians, and skeptics of the existing system. Then something changed. The rise from experiment to obsession. As Bitcoin survived its first tests, something powerful happened. Belief turned into price. With every year Bitcoin didn't die, confidence grew. Media attention followed. Early profits attracted speculators, exchanges emerged, liquidity increased. And once price charts started going up, psychology took over. Ethereum expanded the vision. Smart contracts promised programmable money. Decentralized finance promised banking without banks. NFTs promised ownership without intermediaries. Each innovation layered complexity onto belief. But complexity doesn't eliminate human nature, it amplifies it. The cause and effect chain was predictable. Rising prices attracted new users attracted builders. Builders attracted capital attracted leverage. Leverage attracted fragility. Crypto didn't just grow, it financialized itself. And that's when the breaking point began forming, quietly, invisibly, underneath the hype. Breaking point. When the system was tested. Every financial system eventually faces the same question. What happens when confidence disappears? Crypto's breaking points didn't come all at once. They came in waves. Exchange hacks exposed security risks. Stablecoins lost their pegs. Leverage unwound faster than models predicted. Projects backed by guaranteed yields collapsed overnight. But the most revealing moments weren't technical failures, they were behavioral ones. When prices rose, decentralization was celebrated. When prices fell, everyone looked for someone to blame. Platforms that promised transparency revealed hidden balance sheets. Founders who preached trustlessness demanded trust. Investors who claimed long-term beliefs sold at the first sign of fear. Crypto didn't fail because of bad code. It failed because human incentives never changed. And just like every historical financial mania, the collapse exposed truths that had been ignored during the rise. What was left behind? After each crash, the same pattern repeated. Retail investors exited in pain. Institutions paused, then repositioned. Regulators stepped in slowly, imperfectly. And developers kept building quietly. The fallout wasn't just financial, it was psychological. Belief fractured. Narratives shifted. What was once the future of money became a risky asset class. Long-term visions were replaced by short-term survival. But here's the paradox. Every crypto winner made the underlying infrastructure stronger. Security improved. Standards emerged. Custody evolved. Use cases narrowed, but deepened. The system didn't disappear. It adapted. Which brings us to the most dangerous moment in any financial story. Failed fixes. Why the same mistakes return? After every crash, fixes are proposed. More regulation. Better audits, smarter investors, new consensus mechanisms. But the core issue is never addressed. Crypto doesn't fail because of insufficient rules. It fails because incentives reward risk-taking during booms and punish caution. Leverage always creeps back in. Speculation always outpaces utility. Narratives always outrun reality. History shows this clearly, from the Dutch tulip mania to the dot-com bubble to the housing crisis. Technology evolves. Behavior doesn't. And crypto, despite its revolutionary tools, is not immune. Modern parallels, the pattern repeating again. Today, digital assets are no longer fringe. Banks offer crypto custody. Governments explore central bank digital currencies. Institutional capital flows in cautiously. Tokenization of real-world assets is no longer theoretical. But the same signals are flashing. Rapid price appreciation without matching adoption. Financial products built on top of volatile assets. New narratives promising safety during uncertainty. The mystery isn't whether crypto will crash again. The mystery is who will be prepared when it does, and who won't. Because every cycle creates winners. Not by timing markets, but by understanding patterns. Final takeaways: what this story teaches us. Takeaway 1. Cryptocurrency is not a rebellion against history, it's part of it. Understanding past financial cycles is more valuable than predicting prices. Takeaway 2. Technology can remove intermediaries, but it cannot remove human emotion. Fear and greed remain the most powerful forces in any market. Takeaway 3. The long-term impact of digital assets will not come from speculation, but from quiet integration into systems people already trust, often in ways that don't look revolutionary at all.